The US labor market is still growing, but it is losing some of its momentum. The economy added 130,000 non-farm payroll jobs in January. That is a modest number. It came in below the pace many economists consider healthy, and it signals a hiring environment that is cooling, not collapsing. The unemployment rate held at 4.3%, steady but not low enough to suggest the kind of tight labor market that defined the post-pandemic years. So, what is this report actually telling us? Healthcare, social assistance, and construction led the gains. Healthcare has been a reliable source of job growth for years now, driven by an aging population and steady demand for services. Construction activity held up despite elevated borrowing costs. Mortgage rates remain high by historical standards, but builders kept hiring. Those are the bright spots. On the other side, federal government employment fell during the month. So did financial services. The federal job losses are worth watching. Reductions in public sector headcount can drag on overall payroll numbers, and they may reflect broader spending pressures at the federal level. Financial services tends to fluctuate with credit conditions and business activity, so that contraction is less alarming on its own, but it adds to the softer tone of the overall report. For the Federal Reserve, this is a mixed picture. The central bank has spent months trying to determine whether the labor market is still tight enough to keep inflation elevated, or whether conditions are cooling enough to justify cutting interest rates. 1 month of 130,000 jobs does not answer that question definitively, but it does suggest some easing in labor demand. The Fed will note that 4.3% unemployment is still relatively low by historical standards. This is not a labor market in distress, but the direction matters as much as the level, and the direction here is softer. Bond markets and equity investors will be parsing this data carefully. A weaker jobs number generally reduces pressure on the Fed to keep rates high. That tends to push bond yields lower and can lift stock prices. Whether one report reshapes the broader narrative depends on what comes next. Inflation data, jobless claims, and future payroll readings will all factor into how the Fed frames its next decision. The key question after any single jobs report is this: is it a trend or is it a blip? January's number alone cannot answer that. What it can do is shift the balance of probabilities, slightly, toward a Fed that has more room to consider rate cuts if the next few data points confirm the softness. Watch the upcoming inflation figures. They will do more to shape the Fed's path than this report alone. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.